Hi, I'm Kobe Cook.
I'm Monica Cook.
I'm Nate.
I'm Brooke. I'm Kathy.
And I'm Landon, and today I'm going to be giving y'all a presentation over the power of investing in the market, turning time and consistency into wealth. The overnight advantage. Imagine waking up each morning a little richer than you went to sleep. This isn't a fantasy, it's the quiet power of investing. No alarm clocks, no overtime, no boss, not even the lift of a finger. It happens through compound growth, one of the few forces in the world that rewards patience over effort. Reason to listen / credibility. Although I am no financial expert, I am someone who has wondered why some people build wealth quicker than others, but still put in the same number of hours and receive the same pay. Then I learned something about money management and investing, what you make to earn double. The more I've researched investing, the more I've learned it's not luck, some crazy inheritance, secret knowledge. Instead, it's a mindset anyone is capable of learning. I've always been fascinated by watching money grow through following simple systems anyone can understand. I have studied many top investors and read multiple books about investing. The building blocks of wealth. In this presentation, we'll explore 3 core avenues of the stock market: stocks, index funds, and mutual funds. Each a powerful tool in your journey to grow wealth over time. Stocks. What is a stock? A stock is the investment of a share that represents ownership in a company. When buying stocks, there are 3 components you'll want to look at that basically tell you if it's a good or bad pick: the PE ratio, the EPS, and the DPS. I'll explain what these are in the next few slides. The PE ratio stands for price to earnings ratio. This helps investors see how much the market thinks the company is worth. In other words, it's a quick way to gauge how much you're paying for each dollar of your earnings. So high PE ratio, 25 plus, investors are willing to pay more because they might expect a lot of future growth. This, in today's world, is tech stocks, AI. It's booming, all PE ratios are high. That's what the rocket ship represents. A low PE ratio below 15, this may come off as a bargain or a sign the company isn't growing. Sometimes a company could be growing, but they're reinvesting all their profit back into the company for more growth, causes a low PE ratio. Still not a bad buy if you think it's going to grow. And that's the caution sign. Neutral PE is 15 to 25. The stock is not overvalued or undervalued. It aligns with average expectation for similar companies. This is going to be Microsoft. Balanced, improving over time, but no huge growth overnight. And that's your balance over here to the right. Negative PE is the company is not currently profitable and currently losing money. That's your caution sign, sorry. The neutral is your thumbs up. That's where you don't want to invest in those, because a negative, you're losing money, you're not profiting at all. The EPS, which is earnings per share. The EPS shows how much a company makes for each share of stock. Think of it like a pizza. The investors buy a slice of the big piece of pizza. The bigger the slice, the more profit each shareholder is going to get. To find the formula for the EPS, you divide the net profit by the number of shares, which is over to the right. And let me give you an example. A company earns $1 million in annual net profit and has 500,000 outstanding shares, 500,000 outstanding shares in which investors can buy. After dividing 1 million by 500,000, you get 2. This means for every share an investor owns, you're going to get $2 on that share for however much it goes up. DPS, dividend per share. What is a dividend? A dividend is a piece of a company pays back out to shareholders annually or quarterly. Think of stocks like trees. If you buy a stock, you're buying a tree. The apples, which if you buy a stock like an apple tree, you're going to reap the apples while the tree is growing, but you're also going to have the large tree after growth. That's basically what a dividend is for a stock. In short, dividends are a company's way of saying, thanks for investing in us. Here's a chunk of profit we've made from your investment. We'd like to give back to you. So dividends are always a plus when looking for stocks. Okay? Life just got easier for people who don't want to look at stocks. You don't have the time, you don't want to dissect into that. So let's say you don't have time to scan through the stock market, find a stock you'd like to invest in. This is where index funds come into play. Buying an index fund is like buying a basket of apples, which is stocks, so that if some underperform, the others in that same basket are going to overperform and make up for the underperformers. The more diversified portfolio reduces the risk. In the next few slides, I'll explain what they are, the benefits of choosing them, and the different types to select from. So what is an index fund? An index fund is a type of investment that holds a diverse portfolio of stocks designed to mirror the performance of a specific market index, such as the S&P 500. It's the basic one everyone knows. These come in a multitude of different things: tech stocks, total stock market funds, big, small, or mid cap. Big is going to be Apple, Microsoft. Small, you're not going to know what they are. That's what that means. Since 1957, the S&P index has delivered an average annual return of 10.33%. This is considering the real estate crash, the tragedies, So it's still earning 10.33% with all those. So the benefits of an index fund. The main benefit of an index fund is low risk to great reward ratio. It is a guaranteed money growing machine. The more time you give the machine, the more the money grows. It doesn't require research or the burden of having to manage, selling, and buying when your emotions overpower your logic. It is also a less time consuming way for someone to invest their money. No need to find and pick stocks, just simply look at the trends in history and let history repeat itself. Here is a detailed chart of the basic S&P 500 returns for 1998. So all these long reds you can see, so from 2008, which was a real estate crash, you can see it's long red. Immediately after that, you have a lot of green. That is the same way all throughout history. If you check that out, you always have more green than red. How are they most cost effective? Index funds are cost effective because there's no active fund manager. You're not paying anyone to sell and buy stocks while you're not looking. All you do is you buy and hold, basically. Very small expense ratio. There's no one managing the fund. You don't got to pay no one. Small expense. You only need an initial investment of X. Then you continue to have an affordable monthly payment based on your income. For X amount of months, it would compound and grow. This would be your formula right to the right, not the bottom on the top. You can also pull the money out at any time, and you also don't have to have a monthly plan to put money in. It's okay to miss months, just try to make up for them later. Formula. P, which is the monthly investment. I, which is the interest rate per period. N is the number of periods, X months, so that would be how much money you put in per month to let it grow. Minus 1, this is your initial payment for not earning interest only for the first month because you put your initial investment in. And then 1 plus I is every other payment is multiplied to calculate compound growth. Example. The initial investment of $3,000 with $300 payment for 20 years with a 10% annual rate of return, which is what we just looked at, is common. After 20 years, you would have invested $75,000 and would take out $250,000. If you left it in there for only 20 more years, you would then take out a total of $2,324,280. This is the time part. Time multiplies it tremendously. A mutual fund. A mutual fund is like an index fund, however, instead of tracking the market, there's a professional team of investing for you to try and beat the market. So this is where people are selling and buying your stocks to try to hop on trends. The key part of this strategy is the team of investors. Pros versus cons. Comparing to an index fund, pros, you potentially beat the market, maximizing your profit. Cons is expenses are higher, you're paying an expense ratio, not consistent with performance, and often unperformed long-term, less tax frequent due to constant trading. Risks are higher because you are relying on the market and the manager of your mutual fund. So if you find a manager you know is consistent beating the markets, it's good, but those are not very common. While this seems risky and an unproportionate of pros and cons, finding the right team of fund managers do exist. It's just extremely difficult to find them. Small steps, big results. Now that you've learned a little bit about investing in stocks, index funds, and mutual funds, investing is a powerful tool in building long-term wealth. It is not something to rely on in the present, but something you can do in silence and reap the harvest you've sowed later in life. Closing up. The truth is that time is your biggest advantage. Every dollar you invest today has the potential to multiply over the years. You don't need to be rich or a financial expert to start, you just need to start. Whether it's an index fund, a mutual fund, or even a single stock, the earlier you begin, the more your money can work for you. So take that first step, your future self will thank you.
Good job.
Thank you. That was awesome. You got another one?
So fast.
I'm gonna have to cut